the early 2010s, European investors faced extreme volatility due to the sovereign debt crisis. Countries like Greece and Spain experienced sharp market declines, with banking sectors losing over 50% in value. However, investors who had diversified globally, holding exposure to US tech stocks, emerging market bonds, and Asian equity indices, were far less impacted. Some even saw gains from US equity rallies during the same period. This real-world scenario illustrates that regional risks can be mitigated with global diversification, helping long-term portfolios weather local storms. Global diversification is the practice of spreading investments across various regions, industries, and asset classes. Rather than concentrating on a single country or sector, you gain exposure to different economies with distinct growth drivers and risk profiles. Risk reduction. Different markets respond differently to crises and cycles. Exposure to growth. Access high-growth economies outside your home market. Currency diversification. Hedge against inflation and FX risk in your home country. Return smoothing. Gains in one region can offset losses in another, reducing portfolio volatility. Sectors. Technology, healthcare, financials, energy, consumer discretionary. Regions. North America, U.S, Canada. Europe, Germany, UK, France. Asia, China, Japan, India. Emerging markets, Brazil, Indonesia, South Africa. Each geography has strengths and weaknesses tied to political stability, innovation cycles, regulatory environment, and currency dynamics. ETFs, exchange-traded funds, diversified low-cost exposure to global regions or sectors. Mutual funds, actively managed options with global mandates. Global index funds track indices like MSCI World, FTSE All World. ADR, GDR listings by foreign companies listed on your home exchange. ETFs are particularly popular due to transparency, liquidity, and ease of use. Home bias, overweighting your local market out of familiarity. Overexposure to USD or Euro assets. Even if globally diversified in companies, currency exposure matters. Neglecting rebalancing. Without regular review, portfolio weights can shift drastically over time. Diversification works best when it's intentional and maintained with discipline. Think globally. Invest across regions and sectors. Use tools like ETFs and index funds to gain efficient access. In the next chapter, we'll examine the role of cash and dividends in supporting long-term stability and passive income generation.